Suppose you've decided you want to include some exposure to fixed interest in a portfolio that you are constructing. As with equities, diversifying your exposure to fixed interest across a variety of instruments can mitigate the outcome of specific risk of failure. The risk that bond investors worry about is that an issuer might go broke or default on its bonds. How will you address this risk? It's quite costly to go out and buy a diversified portfolio of bonds as an individual investor. Investors typically face large transaction costs when they are looking to buy small parcels of bonds. Moreover, if you are selecting individual instruments, how will you decide which type of instrument and which maturity to choose? As you can see, with the 3-year and 10-year Australian Treasury bond yields on the left-hand side of this chart, the yields on fixed interest securities fluctuate through time. Because of the inverse relationship between bond yields and prices, this means the capital value of your investment will fall when yields rise, and it will rise when yields fall. The yield on a bond is an indication of the return which an investor will receive through the maturity of the bond if interest rates remain at their current level. A chart of yields is, in essence, a lot like a price graph. It does not show the total return, which is a combination of price changes and your coupon income on your fixed interest investment. If you are investing in fixed interest through a fund and reinvesting your dividends, your total return includes both. Total return is shown in the blue line on this chart, which is referenced in the right-hand vertical axis. Compound income has been a significant part of the return on the UBS Composite Index through time. Indeed, a fund tracking the UBS index, such as Vanguard's Australian Fixed Interest Fund, returned 6.6% for the period between 6th of June 1997 and 31 December 2011. Of that return, 5.9 percentage points came from compound income, while 1.1 percentage points resulted from price appreciation. As you can see, it's more practical to capture these bond market returns by investing in a managed fixed interest fund, or ETF, than by investing in individual securities. Funds come in a variety of bond investment strategies across government, corporate, and blends. They are also a much lower cost way to acquire exposure to a broad set of fixed interest securities. They are lower cost because managed funds and ETFs can access institutional pricing.